Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stocks, geopolitics, CHIPS Act investments, and institutional positioning. This video presents a direct, informational narration of the source document. Okay, let's take a quick look at our agenda for today. We'll be covering four main areas. First up, market and geopolitics. Then we'll look at macro data and U.S. Treasuries. Third, we've got tech equities and the CHIPS Act. And finally, we'll wrap up with institutional positioning. Section 1. Market and Geopolitics. Let's dive right in.
So, as of 8:35 p.m. Eastern Time on Thursday, May 21, 2026, the four major indices actually closed higher, but man, was it after a highly volatile trading session. Right now, the market is busy absorbing some pretty contradictory geopolitical news regarding the Middle East conflict. According to reports from Reuters and Politico, the two major factions are still hyper-focused on the Iran nuclear program and the reopening of the Strait of Hormuz. However, despite earlier plans, the Pakistan Army chief is not expected to travel to Tehran tonight. And while Reuters reported that negotiations have narrowed the differences, there's absolutely no agreement reached yet. This uncertainty has led to severe intraday market volatility. We saw prices initially drop, then rise rapidly, fall again, and then finally recover. It's a total whipsaw action, heavily driven by algorithmic trading that's just reacting to unverified reports. Ultimately, this leaves short-term market expectations largely absent and pretty chaotic.
Moving right along to Section 2, Macro Data and U.S. Treasuries.
Let's look at the economic data regarding initial jobless claims for the week ending May 16. Things remained quite stable, slightly decreasing to 209,000. That figure is actually lower than the expected 210,000 and the previous period's 211,000. Meanwhile, continuing claims stood at 1.782 million, essentially flat compared to the previous week and just slightly below the expected 1.785 million. It's worth noting that initial claims have maintained a very narrow trading range for over 3 consecutive months now, staying well below historical high levels. This continued labor market stability is a strong signal that the Federal Reserve will likely concentrate more of its efforts on addressing the upside risks of inflation.
Beyond those base inflation expectations, market anxiety is really being driven by rising Treasury yields. We're specifically looking at the 10-year global benchmark and the 30-year long-end U.S. rate. Both of these are entering riskier territory with elevated real yields. Plus, large market participants have been continuously selling off U.S. Treasuries since March. Why? Well, it's driven by a combination of rising inflation expectations, less attractive yield conditions, and geopolitical and energy shocks that are causing widespread currency depreciation. As a result, central banks are dumping U.S. Treasuries to defend their own domestic currencies. To put that into perspective, in just a single month, total foreign holdings of U.S. Treasuries dropped from $9.49 trillion down to $9.25 trillion.
Breaking that down specifically, China's holdings of U.S. Treasuries decreased to approximately $652 billion. That marks the lowest level since 2008. Japan, which is the largest foreign holder, also significantly reduced its position to defend the yen. And Turkey, they entirely liquidated their U.S. Treasury holdings due to severe currency depreciation pressures following the Middle East conflict. And that was after they previously sold off significant gold reserves. Now shifting over to global oil prices, investment banks are anticipating a decline, but Brent crude is still expected to maintain a price range of $80 to $90 per barrel into the fourth quarter. When you compare that to the pre-war level of approximately $70 back in February, a $90 price represents a nearly 30% increase. That absolutely sustains the pressure on inflation.
Because of all this, market expectations for interest rate policy have totally reversed, and hawkish voices are now dominating in the U.S. Unless the Federal Reserve alters its inflation framework during the June quarterly meeting, to permit temporarily higher inflation while maintaining an easing stance, that hawkish position is expected to persist. Consequently, long-duration Treasury products, like the TLT ETF, face some serious headwinds for any substantial upside. It makes them really difficult assets to trade in our current environment.
Section 3, Tech Equities and the CHIPS Act. Let's shift over to corporate developments. According to the Wall Street Journal, the U.S. government is preparing to approve $2 billion in grants under the CHIPS Act for quantum computing companies, and they're doing this in exchange for equity. IBM is expected to receive the largest chunk of that, totaling $1 billion. Global Foundries is slated to receive approximately $375 million, with the remainder being allocated to other firms, including QBTS, RGTI, and FQ.
This strategy of exchanging government capital for corporate equity very closely mirrors previous government interventions we've seen in the private sector. Looking at historical precedents for these types of government equity injections, the Department of Defense invested in MP Materials around July 9 to 10, 2025, acquiring a 15% equity stake. The stock price surged 50% that exact same day. It eventually climbed to $46, then $82, and peaked at $100, completely driven by market speculation. Since then, it's retraced to $50 and is currently hovering near the $60 mark. The forward price-to-earnings multiples for MP Materials reflect a very low initial base combined with high expected growth. We're looking at a range from 7 to 13 for 2026, and then it jumps to a median of 46, with a range going all the way up to 58 for 2027. That massive trading volume between $87 and $100 suggests that significant speculative capital remains trapped up at those upper levels, and it's going to require considerable time to recover.
We saw a similar story with Intel. The government invested $8.9 billion in Intel around August 22 via the CHIPS Act, acquiring an approximate 10% equity stake. Interestingly, the stock initially saw a pretty muted reaction. It rose only 5.53% and then basically traded sideways due to weak earnings fundamentals and a lack of major clients. However, on September 17, NVIDIA came in and announced a $5 billion strategic partnership with Intel, suggesting future product integration. This highly orchestrated combination of government backing alongside a major corporate partnership caused Intel stock to surge 22% that very day. Currently priced at $118, Intel is actually considered fundamentally overvalued based on its current earnings, with the price largely being sustained by heavy speculative interest in semiconductor hardware.
So, this precedent raises a really interesting question. Will IBM be the next target for heavy market speculation following its government grant? From a fundamental standpoint, IBM's forward valuation appears fairly reasonable following a recent pullback. The forward price-to-earnings metric for 2026 suggests a target range of $185 to $309. For 2027, the range is $200 to $330, with a median of $266, which indicates single-digit growth. At its current price, sitting in the $200 range, IBM is not considered overvalued from a fundamental perspective, and that definitely leaves room for potential speculative inflows.
On a technical basis for IBM, breaking above $262 will definitively confirm the end of its downward consolidation and establish a bottoming state. Just above that, there's medium resistance existing at the 200-day moving average of $267, which might trigger some algorithmic selling. That's followed by a prior trap liquidity zone sitting right between $273 and $287. However, the trading volume in that upper resistance zone has been steadily shrinking, which suggests the trap volume is relatively light and really represents only a moderate resistance level.
Now, regarding specific technology equities and private investments, there is extremely high market anticipation surrounding the potential IPO of SpaceX. Google holds a substantial equity investment in SpaceX. Should the IPO proceed with significant price appreciation, it would generate a massive book return for Google, materially improving its balance sheet. Because of this, some market participants are actually utilizing Google equities as an indirect vehicle to gain exposure to SpaceX prior to its public listing. And, as you might guess, that could lead to rapid price volatility for the stock.
Finally, Section 4, Institutional Positioning. When analyzing institutional positioning via the 13F reports for the first quarter, we can see that mutual funds continuously sold software equities while heavily increasing their allocations to semiconductors. Large mutual funds actually increased their overweight position in semiconductors by 49 basis points. That's an increase of 25 basis points quarter over quarter. Conversely, if we exclude Microsoft, the underweight position in the software sector widened to negative 36 basis points. That marks the lowest level since at least 2012. Additionally, the mutual fund allocation to the top 7 megacap stocks remains severely underweight at negative 723 basis points, though that's largely due to structural diversification limits.
To really understand this, it is crucial to look at the structural makeup of mutual funds. They are predominantly comprised of capital coming from retail investors and households. In fact, they represent 94 to 95% of assets under management, primarily held through 401k and retirement accounts. With the average individual investor asset size sitting at $125,000, mutual fund data essentially reflects a massive aggregate of steady retail sentiment. And right now, this sentiment demonstrates a continued preference for avoiding broader software investments while actively chasing artificial intelligence hardware.
Hedge fund positioning, however, presents a very contrasting trend. Tracking hedge fund semiconductor exposure reveals continuous buying through January and February, flatlining in March, and then just a slight rise early in April.
But from mid-April all the way through May, hedge funds have been continuously reducing their semiconductor exposure. In contrast, hedge fund software exposure saw reductions from January to March, then a brief short covering bounce and a subsequent decline. But entering late April and May, we see hedge funds have slowly begun adding back to their long software positions without significant further reductions.
Despite those hedge fund reductions, semiconductor indices are continuing to push toward new highs. We're seeing significant straight-line price appreciation driven by strong fundamentals in companies like NVIDIA, all alongside heavy retail inflows. Meanwhile, software indices are slowly grinding higher from their lows, with their forward upward targets remaining perfectly intact. This divergence sets up a really intense structural tension. Hedge funds that are currently shorting or reducing semiconductors could face severe short squeezes if that retail momentum persists. This would force rapid capitulation and short covering.
While the underlying fundamental outlook and earnings revisions for semiconductor hardware remain exceptionally strong, we have to acknowledge that rapid, uncorrected, straight-line price surges carry inherent volatility risks. Market mechanics dictate that perpetual upward gaps without any retracements are just unsustainable long-term. For participants engaged in speculative trading within these high-velocity sectors, securing the initial principal while allowing the remaining profits to run is noted as a method to mitigate the outsized risks associated with sudden market reversals.